This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell. Hello and welcome to the AJ Bell Money and Markets podcast. I'm Danni Hewson, and it's been another bonkers week for markets as Donald Trump returns to the White House and investors pile in to benefit, or not, from what are being called Trump trades. Joining me this week to discuss all of that and the continued fallout from the UK budget, which, can you believe, was only a week ago, is Charlene Young. Hi, Charlene.
Hi, Danny. Yes, I'm absolutely feeling you there. It does feel like how longer than a week ago, but there has been a lot to go through in those documents that we mentioned in our budget special last week. So I'll be looking at changes to inheritance tax and been crunching some numbers there and thinking about pensions being brought into someone's estate. And there's the pre-budget moves that many people made because they were concerned about potential changes that might be coming in. I'll be talking about paying back the taxi cash you might have accessed if you didn't actually need it.
Staying with the budget and what it might mean for some of the UK's biggest listed companies, I've been chatting to Simon Gergel from the Merchants Trust about how some of the portfolio's holdings might be impacted and, since we recorded this ahead of the US election, whether he was putting any plans in place to mitigate a change at the White House.
Tom Seeder and Ian Conway from Shares Magazine talk all things biscuits. I definitely want to tune into that one. They're going to discuss Lotus Bakeries, the makers of Biscoff, which is a big favourite in households and a great stock performer too in recent years. We're also going to be talking about the increase to university fees.
Now, that has been a hot topic in my household, Charlene, because I have my eldest daughter is looking at unis, expecting to go next year. So, yeah, she wasn't pleased to hear that news. It has been what feels like a really insane period of time. And I know we've been waiting for this US election result for absolutely ages. And I think I'd sort of got into my head that Trump was going to be back in the White House. And then there were a couple of days when people were saying, actually, maybe it really is too close to call. Maybe the Democrats might just edge it. I mean, were you surprised by the outcome?
No, I had thought Trump was coming back. I know there was a late surge for Harris, wasn't there, in some of the polls. But I think, even in this country, we've learned that polls don't always come true, to be taken with a pinch of salt. But it did seem really, really close. And then obviously we just saw with those swing states, Trump just kind of surge ahead in what has been quite a comprehensive victory and, more than before. And he's won the popular vote, hasn't he? And taken back control of the Senate as well. So I think the voters have spoken, haven't they?
Well, we've heard so many times that well-used phrase, it's the economy stupid. And that certainly seems to have been the message which voters have sent, that they just weren't feeling as well off. But, of course, it was an unequivocal victory from Trump, and it was apparent from very early on, which meant, of course, that markets woke up to the news that we would have Donald Trump in the White House. And we even before Wall Street opened, I mean, futures were going absolutely bananas. And just looking at the Dow Jones, it closed up 3.6%, the NASDAQ nearly 3%, the S&P 500 2.5%. I mean, records were breaking absolutely all over the place on this news. And clearly, there are potentially a lot of positives that markets are pricing in. So we saw Bitcoin hit a record high. Now, Donald Trump was a renowned skeptic of Bitcoin, had a change of heart. Now he says he wants to make the US the Bitcoin capital of the world, the crypto capital of the world, and has even got his own skin in the game now because there is a family crypto business which was launched earlier this year. So obviously a lot of traders thinking that Bitcoin regulation might relax a bit, that there might be more opportunity there. I don't think anyone was surprised to see Tesla stocks up 15%. I mean, Elon Musk now has the president's ear, doesn't he? Whether or not that is going to be good for America, bad for America. Certainly the expectation is that things like autonomous driving are likely to get a more positive opportunity to go forward. We saw the dollar that surged. Now, that was a good/bad expectation of rates potentially staying higher for longer. And that is because of the potential prospect of higher inflation. I'll talk a bit more about tariffs when we get to the bad part of this particular commentary. But also, he obviously was focused quite heavily on dealing with immigration. And if you take a huge number of workers out of the workforce, as he's certainly talking about doing, deporting people, then wages are likely to go up, and that is likely to impact prices. Just looking at some of the other winners, it was interesting when you look closer to home. So we had Ashtead, which is the big construction company, lends out equipment to people, has a huge presence in the United States. On the FTSE 100, that was significantly up. And also a lot of European defense stocks like BAE Systems, they were also up because, of course, Donald Trump has said that he is expecting Europe to put more money into NATO. Banking stocks were up over the expectation, first of all, that interest rates would stay higher for longer, and also that potentially regulation would relax a bit. Maybe the amount of cash that they have to hold just in case things go wrong might not be quite as much as it currently is. And with we have so many slogans to choose from Donald Trump, but drill, baby, drill, that was one that I've heard him used a lot. And of course, that just meant that a lot of oil stocks like Chevron and ExxonMobil were up as well. So it was just fascinating to watch yesterday as we'd had sort of, with the expectation that maybe, just maybe, Harris was in with a shot. Some of those Trump trades had been sort of unraveled. And I haven't yet mentioned, obviously, Donald Trump's media company as well, the home of Trump Social. Well, that was also up yesterday as well. So it's going to be really interesting to see, just looking at the expectation of where Wall Street's going to open today, not expecting things to be quite as fiery. Whether or not that is because people have sort of made their moves already, or whether it is because there's a little bit of uncertainty about what is going to be said by the Federal Reserve about interest rates. Let's see.
Yeah, and I think it just cuts through, doesn't it? So kind of, you can look at the past and what's happened, whether Democrats have won or Republicans have won. And of course, Trump isn't a typical Republican. He, like you say, he's full of memes, he's full of sayings and stocks. So I think that kind of that bit of edge does, make it quite fascinating to watch, as you said. But there's also been some very clear losers from this result, hasn't there?
Yeah, I mean, we know that Donald Trump is more into the sort of quick win fossil fuels than into renewables. So we saw a lot of renewable companies really sort of looking glum. And I'm not just talking about over in the States, but also the likes of Iberdrola, the Scottish power owner, that saw shares falling, the expectation that wind power in particular is not a favourite of Donald Trump. So there could be sort of rolling back of plans there. We also saw a couple of the smaller EV players, Rivian and Nikola, their shares were down over the expectation that maybe some of those subsidies that are being given to Americans to buy even US-made EVs might be rolled back. Conversely, we saw a lot of the sort of legacy automakers, their stocks were up yesterday. But the biggest concern has to be about tariffs. We know that Trump has said that he loves tariffs. He wants to slap tariffs on absolutely everything. In fact, he said that if he could, he would take away all income taxes and just tax imports into the United States. Now, okay, that sounds intriguing, but we know from the last time that Donald Trump did it, what happened is the American consumer paid because things got more expensive. And the American consumer is really feeling the pain of inflation at the moment. That was the number one thing that they kept saying, that they were blaming Joe Biden and his Democratic Party for higher prices, which had impacted their cost of living. So with the expectation that there could be up to 60% tariffs on Chinese goods and somewhere between 10 and 20% on goods from the rest of the world, any company which is importing into the United States has to be concerned. And it's not just that potentially they'll be able to import less, but also then there will be some kind of tit for tat retaliation. So generally you can expect products to get more expensive. And I know for a lot of people who just feel like, finally, we're at 1.7% inflation here in the UK, and okay, maybe we'll sort of head back up towards 2 and a bit. But we just don't want to see the kind of inflation that we experienced over the last couple of years, because people are feeling weary of the whole thing. And there's been huge concern, and I was talking to someone about the Scottish whisky industry, which had been hit by previous Trump tariffs, 2019 to 2021. I think it was £600 million of lost exports had hit Scottish whisky distilleries. So they were really concerned, and you could just see that concern sort of leaking through to stocks like Diageo on the FTSE yesterday. So yeah, I do think that there are some real issues there to contend with.
Yeah, and it pulls through to rates, and we are recording this on Thursday morning before the Bank of England's decision will be announced at noon. I think we're still expecting a cut at noon, but the real attention is on those forecasts and what might be coming down the line. And we talk about expectations a lot. I feel like I say that word a lot. Is an important one when it comes to economics and things like rate cuts. And like I say, I think we're all convinced a cut will be announced this time, but these expectations and concerns about inflation all feed through to concerns about the general pace and that trend of rate cuts here in the UK. Now, markets pricing in what could be the last cut this time for some months, which is quite a change. If you go back 2 or 3 weeks when we were talking about a 74% chance of back-to-back cuts. So yeah, like you say, uncertainty. Well, life would be boring, wouldn't it, if everything was certain? But like you say, after that kind of long shuffle towards like normal levels of inflation that you were talking about, lower rates, and that long for increase in living standards that everybody is feeling, everybody is desiring, it does feel, I think, like you said, like the rocks kind of being pulled from beneath everyone's feet a little. So yes, we wait to see what will happen.
Yeah, and of course, it's not just Trump's tariffs that the Monetary Policy Committee will be considering when it comes to inflation, because there's also concern that businesses will push up their costs, that they will charge the consumer for the increased national insurance that they're going to have to pay following the budget. And there have been loads and loads of business leaders coming out over the last few days warning that that might well be the case. And we know that Jonathan Reynolds, the business secretary, spoke to a lot of businesses on a call on Monday, and he was absolutely besieged with people saying that, look, this is likely to be expensive. I saw Timothy Taylor's saying that despite the fact that we had that huge cheer in the budget at the penny off a pint of draft beers, they were saying that actually the combined impact of the national insurance hikes and the national living wage increases will mean that they will have to actually put up the price of their pint. So you won't be paying less for a pint, you'll be paying more for a pint. Also, the likes of the supermarket chain Morrison's warning that, potentially this could impact the prices of stuff that we're buying on the shelf. And Fuller's has said, look, it may well be forced to halve their annual investment from 60 million to 30 million. That is according to Sky News, who has spoken to an awful lot of the businesses who were on that call with Jonathan Reynolds. But we've had warnings from the likes of UK Hospitality, the British Beer and Pub Association. We also had a comment from the British Retail Consortium when they released their latest lot of retail sales figures, which looked pretty glum for October, as a lot of people were sort of putting off spending because they were really concerned about the budget that was coming their way. I mean, there was a lot of consumer lack of confidence, wasn't there? And of course, October, normally you would expect to see a big sort of surge because people start squirreling stuff away for Christmas. But this is something that the bank is going to have to look into.
Yeah, and I think you look at the weather, I'm sticking outside now, it feels pretty warm for this time of year. People aren't going out buying those big coats, those kind of one-off big spends that they can. And yeah, like we say, we talk about expectations, and I've spoken a lot about the messaging and the run-up to the budget and the effect it's had on people and the decisions they make. And, you could just see it still feeding through. And, this gloomy picture isn't really a surprise, is it? And talking about more doom and gloom, I'm going to talk about the death tax. I've sort of thought about this before. I thought, what the order I'd be thinking about things. That another huge change, obviously, we saw in the budget were changes to inheritance tax. And they've actually been exacerbated because I'm going to talk about frozen thresholds again. So this threshold, or the allowance that everybody could give away, is going to be frozen for another 2 years. So just to kind of set the scene quickly, to some numbers I've been crunching. So everybody can pass on up to £325,000 before IHT applies, and that's thanks to something called the nil rate band. Now, an additional £175,000 residence nil rate band is also available if you're a homeowner and you leave that property to your direct descendants. So if you put these two figures together for married couples or people in registered civil partnerships, this means up to £1 million can usually be passed on without IHT. Now, we know it's a hated tax, but at the moment, only around 1 in 20 estates pay it. Now, that main nil rate band that I talked about, that's been frozen actually since 2009 and is now, thanks to the budget being going to be frozen for another 2 years, along with that residence nil rate band, all the way through to 2029, 2030. Now, that's over 20 years for that main rate, in a time when obviously we've seen asset prices, house prices, investment prices go up, the value of people's estates go up. But that threshold has been frozen, something we're very familiar with in terms of earnings and frozen tax allowances. Now, what actually has happened, as we said, is that new extra residence nil rate band has come in. But both of these allowances, because they've been frozen, have been eroded by inflation over time. So what we did is we've taken that IHT nil rate band, the 325,000, and uprated it as it would normally be uprated every year with inflation from the previous September. Now, crucially, we looked at even if the government had actually done nothing at all other than inflation linked this original nil rate band, the 325,000, it would actually be higher at the end of the freeze than adding in this new residence nil rate band. So the measure itself, this kind of residence extra nil rate band, has actually been swallowed up by that kind of stealth freezing of the allowances. So if the government had uprated both the nil rate band and the residence nil rate band every year since they've been introduced, that would actually give an individual an IHT threshold of just above £790,000 rather than the £500,000 we have today. And when you add it in for a couple and you think about the IHT impact on those wealthier estates, it could have actually saved families by the end of a freeze £234,000 in inheritance tax. So just some numbers we've kind of been crunching that have been picked up, and it shows again that these frozen thresholds are kind of everywhere. And yes, you might not see rises in the headline rate of tax IHT for most people. It is going to start impacting more than this kind of 1 in 20 that we're all told by the government. I think looking at their own figures, that 2 year extra freeze is going to catch nearly 5,000 more estates, and it will add £500 million on top of the impact of those frozen thresholds.
And with pensions also being pulled into IHT, what should people consider, Charlene?
Yeah, so at the moment, pensions are usually completely tax-free if you die under the age of 75. If you die over 75, then they're still usually free of IHT, but beneficiaries will pay income tax kind of as and when they take the money out. Now, at the budget, the government announced that it wants to include inherited pensions as part of someone's estate for inheritance tax from April 2027. They believe this is going to catch around 50,000 estates by the time it comes in. So that could be people who are already going to likely face IHT on their estates, or actually bringing their estates into IHT for the first time once that pension is added in. And at the moment in the proposals, which are obviously still under a consultation, income tax will also still be payable on the rest of the pot if that pension holder died after reaching age 75. So inherited pensions, it's probably worth spelling out exactly what that means. It's usually what is left in a pot when someone dies. So it includes money they hadn't accessed yet, as well as money they were perhaps already drawing down from. It doesn't include final salary pensions or a guaranteed pension annuity someone was already receiving. So in terms of what people might do and the changes we might see, I think at the moment, someone with assets in lots of different accounts, lots of different pots, pensions and non-pensions, I think at the moment you see people typically take income from those other accounts before turning to the pension pot if they're able to kind of leave it there for their beneficiaries. But I think we'll probably see people turn on that pension income tap now to spend them in retirement. So that would reduce the value of their estate potentially for IHT from 2027 onwards. Another thing, people who have significant other income that kind of covers their day-to-day and their standard of living might also consider turning on that pension income tap to fund regular gifts. So one of the really valuable gift exemptions, if you're able and willing to make use of it, is that gifts from income, not savings, it has to be from income, and gifts that don't reduce your standard of living are completely IHT free. There's a lot of record keeping that has to be done, but people in that position might turn on that pension tap, start giving away more money now, which is kind of something certainly the government would probably want to see, that money coming into the real economy being spent. We'll probably see that behavioural change, and of course annuities might get a little bit more interest too. So people who were planning to leave money in their pension to give it away very tax efficiently under the current rules to family after their death might want to revisit their nominations and kind of reconsider their plans in later life, how they might rearrange the order in which they draw down on different accounts. But I think crucially, if this is worrying you and it's confusing you, help is out there. So in my view, this was definitely a budget for professional advice. Good quality financial planners, good quality lawyers who specialize in this area of estate planning, their services are going to be needed. So, if you want formal advice and planning, it is out there. But if you're kind of concerned about your pension options as you're approaching retirement, if you're over 50, you can get free information and guidance from the government-backed service pension-wise. So, whether you just want some information and guidance now, or you want the kind of full range of estate planning options, I would say help is out there.
And whilst we're talking pensions, there was so much speculation before the budget about tax-free cash, that there might be a change in the amount that people could take. And I know we had lots of calls from people wanting to access that cash when in other times they might not normally have done so. Now, some of them finding that actually they might want to put it back. Can they?
Yeah, so when Tom came on, he was talking about our calls for the pension tax look, and I'm not going to say too much about it because I've said a lot about messaging, and I'll get cross when I think about it. But yes, we saw that messaging or lack of in when it comes to pensions, causing people to make choices that perhaps they wouldn't have ordinarily made. We even saw the government-backed money helper service come out, and HMRC with newsletters and guidance about don't necessarily access your tax-free cash if you don't need it, which is quite unprecedented, really. So if somebody truly wants to pay back in, or someone truly regrets taking their tax-free cash and they think, well, it's just sat there in a bank account, I don't need it, I shouldn't have done this, they might be able to pay it back in. So when you apply for certain financial products, the Financial Conduct Authority, our regulator, the FCA, the rules say that you must be given the right to cancel. So this normally applies for like new pensions or new ISAs, but there's also a right to cancel when you access a personal pension like a SIP for the very first time. So if we're thinking about SIPs here, this could mean cancelling your request to take tax-free cash for the first time within 30 calendar days. So if you're someone who kind of hoovered up the rest of your tax-free cash allowance because you've taken some a few months ago, a few years ago, you won't usually be able to use these cancellation rights. But if this is the first time you took your tax-free cash and you're now regretting your decision, get in touch with your provider and see if you're able to pay it back if you feel that's right for you. Obviously, this isn't saying you should do this, but what you should do is just maybe speak to your advisor and get hold of your options. So in your SIP terms and conditions, it should all be laid out, but this cooling off cancellation period is normally 30 calendar days from the date you're given your cancellation rights. So your provider normally would write out to you or send you an email with confirmation in writing that they've processed your request. They'll tell you what your right to cancel is, and then it's normally 30 calendar days from then, not working days. I think that's also crucial to point out. So have a look at what was sent to you at the time, speak to your provider. The exact process will obviously vary from provider, but get the information about what you can do, and that will help you make a decision. Obviously, you need to return the money that was paid out to you. So if you've already spent it and you can't get it back, then you're not going to be able to return yourself to that original position. It's not a case of just paying a bit of it back in. It would have to be all of it. So if someone's still got it just in the bank and they haven't spent it, that might be a possibility, might not be possible for everybody. Now, once that money has been returned, if you do go ahead and do it, your pension will be treated as if you'd never accessed it, and any kind of lump sum allowance you'd used at the time will be restored. Obviously, have a think about any extra fees, if that's bank transaction charges to get the money back really quickly, same day, if you're near that deadline, and also fees you might have to pay to reinvest the cash you've paid back in. Markets might have also moved against you in the interim, but if you really want to cancel that move and you feel that's the right thing for you, that you might think that's a small kind of price to pay.
Thank you, Charlene. Now, sticking with the budget for now, let's hear from Simon Gergel, who manages the Merchants Trust, an investment trust which focuses on high-yielding UK companies. I spoke to him before the US election and the Bank of England's interest rate decision and asked if the budget had created any concerns about the companies in the portfolio. Simon, thank you so much for joining us. Obviously, everybody at the moment is talking about the ramifications of Labour's first budget. For your current holdings, does it have a positive or negative impact, or is it not something that you're particularly concerned about?
I think the main thing is to get it out of the way, because there's been so much uncertainty ahead of the budget that a lot of activity has been paused or put on hold. People have been uncertain about what might happen. I think in the end, what was announced in the budget was not very different to what the market assumed. In fact, in some cases, probably a bit more benign. So if you take the energy industry, the way the tax and capital allowances was announced, looks a bit easier than some of the expectations beforehand. Perhaps the biggest area that is affecting companies might be the increase in national insurance and the minimum wage, which is putting a bit more strain on companies that employ a lot of labour, particularly minimum wage labour. So retailers, companies like Tesco with a lot of staff could be impacted by that. On the other hand, it was quite well known that there was going to be some increases there. And also, if there's more money in the pockets of consumers, then actually there may be more spending in the shops as well. And it puts pressure on competitors as well. So if you're a company that's trading well, like Tesco, and outperforming, it's not necessarily tricky. So overall, actually, I think the main thing is to get the budget out of the way and to allow companies to get back to their day job, really, and plan and work and invest and get on with things. And I think there's a sense of relief, perhaps, that it's out of the way now and we can move on.
It's interesting that you talk about that sort of swings and roundabouts at the moment. Potentially one thing that could happen is inflation rearing its head again. And I know that lots of the holdings that you have make money outside of the UK, and with expectation that interest rates are going to stay higher for longer, the pound likely to stay strong, which negatively impacts many FTSE 100 companies.
Well, yes, potentially, but trying to call where the exchange rate's going to go is notoriously difficult, and markets price in an awful lot in advance. So, in theory, yes, the stronger sterling is, the less advantageous it is to earn money overseas. If you look at our portfolio, we've probably got a bit less overall in international stocks and a bit more in domestic stocks than the market average. So even though we've got over half the earnings and revenue coming from abroad, the market average is something like 70%. So we're slightly under that. So to the extent that sterling rising is a drag, it might affect us a bit less than it does other portfolios or the market generally. But I don't think it's a massive issue. I mean, sterling bounces around. Over the long term, it's much more important to be in the right companies that can generate strong returns and decent growth, and you can buy them at the right prices, than worrying too much about day-to-day movements in sterling.
To that end, you are cutting holdings in strong performers, reinvesting in weaker performers. Does that increase risk, and why that strategy?
It's a great question. We could spend an hour on that alone because it depends a lot on what you mean by risk. So if we take it back to first principles, we are value investors, which means that we believe that the price you pay for a company is a really important determinant of the return you're likely to get. And if you buy a company when it's cheap, you're likely to make a better return than if you buy it when it's expensive. And there's a huge amount of evidence that that's true overall on average, historically. Now, if you follow that logically, as the share price comes down, if nothing else changes, the company is cheaper, and therefore you should be logically increasing in position, having more of it. And when the share price goes up and the shares get more expensive, you should be reducing. In practice, of course, shares go up and down for all sorts of reasons. Sometimes they go up because there's good news, things are going better than they expected or you expected. And sometimes they go down because there's a fundamental problem. So as an investor, you have to always try and separate, is the company going down, the share price going down for a genuine reason, which means the value has dropped? Or is it an opportunity to increase the position because the fundamentals haven't changed? So we spend our life really trying to understand when a share price moves, has something really changed or not? And if nothing has changed and the share is 10% cheaper than it was, it's logical for us to try and put more money into it. Now that's a fairly contrarian strategy. It has worked very well in the long term for us. We've delivered very strong numbers by following that approach. But at any one time, any individual company can potentially be impacted, and you may well be going against the trend. It may be painful for a while, but that's our approach, and it's very different to, for example, the way a growth investor might look at the market or a momentum investor.
So have you got a shopping list that you always have? You're just watching to see what's coming down the tracks?
Well, there are a number of companies we're keeping an eye on that we think might at some point be attractive, but more importantly, every company in the portfolio, we're constantly reassessing what's changing in that business, what's it worth, and if the shares are moving, does that give us an opportunity to either increase the position because it's got cheaper, or potentially take some money off and reinvest elsewhere? There's always a competitive tension or within the portfolio of companies that you might want to reduce and other companies you might want to increase because of where they are in terms of valuation. So it's just a regular day-to-day part of the investment process, really.
Let's talk about a couple of the individual holdings that you have. China, obviously, we've been talking about China's stimulus for what seems like a very long period of time. The current package seems to be slightly different. It's certainly changed investor sentiment. Do you think it's going to boost commodity demand, and the likes of Rio Tinto, which is one of your top 10 holdings, potentially could benefit?
Well, I think it could help. So, I mean, clearly the Chinese economy is in a difficult state, and the government is trying to do everything it can to boost demand, boost consumption, boost activity. And China is a massive market, incredibly important for the commodity companies such as Rio Tinto. And so you can't really avoid having a view, at least implicit view on China when you invest in Rio Tinto. So yes, I think it could be helpful, but I think we need to put this in context. We don't have a particularly large exposure to the mining industry. I think within the industry, we do like copper as a commodity. We think the long-term demand and supply balance to copper is particularly attractive. We have another mining company called Atalaya in the portfolio, which is purely copper. And of course, Rio's has a decent position in copper, which is growing, as well as a strong position in aluminium, which they have a low carbon aluminium. Essentially, their aluminium is produced by using hydroelectric power in Canada, most of it, which I think gives it a long-term competitive advantage. And therefore, those two commodities I think are very powerful for Rio. It also has a very large iron ore business, which is very dependent on China in particular. And that one's, more, I'd say more balanced, positives and negatives. Clearly, China is a very strong source of demand for that, but China's economy has been pretty weak. So I think if I take a step back, what we're saying is we think Rio is a good company within the mining sector. I think the mining sector is slightly challenged, but the share price of Rio is discounting quite a bit of pain or quite difficult conditions. It's quite lowly priced at the moment. So on balance, we think there's a case, certainly we did when we bought it, for having Rio in the portfolio.
So you're always looking at changing trends then, emerging trends. Is there anything in particular that you're excited about, that you're thinking, right, maybe we'll get into that?
Well, as I say, copper, because if you look at where the demand for electrification of the grid, so if we're going to have a lot more electric cars, if we're going to move from supplying gas boilers to electric boilers and heat pumps, there's going to be a massive demand in the need for electricity over time. And that can only be supplied by having a lot of copper and to some extent aluminium in the transmission grid, by having electric chargers, by having renewable power. All of that uses a huge amount of copper, and the supply of copper is really quite constrained. And that's one of the reasons why we are quite positive and have been for a while on the demand for copper. And because supply is constrained, that probably means that prices will be supported into the medium to long term. So that's one area we are quite excited about. We also have exposure to companies like SSE and National Grid, which are delivering that electricity through the networks that they own and they're building.
It's a fascinating period of time. There's certainly been a lot of volatility, a lot of UK equities still looking pretty cheap, and there is a lot of takeover interest. And I know Tate & Lyle is one that you're keeping a close eye on because it's also in your top 10.
Yes, it's one of our largest positions, Tate & Lyle, and we think that company's gone through a really interesting transformation over the last decade or so. It's moved from being primarily a commodity type producer of high fructose corn syrup and other commodities to really a specialty ingredients company that is now the world leader in mouthfeel, which sounds a bit strange, but it's effectively products that allow you to substitute and change the qualities of the products you're building. So you can take out sugar and replace with low calorie sweeteners, but natural ingredients. You can add dietary fiber to products. If you take out sugar actually from a product, from a food product, you have to replace it with a lot of substance. And Tate & Lyle can produce the starch products that go in and can replace sugar to give you a nice feel in the mouth, a nice taste, and the same amount of sweetness, but without the calories. So they're doing all these types of solutions which are much higher value added than simply supplying the raw materials, the commodities that they historically produced. I think that transformation of the business has been pretty fundamental and pretty extensive, but has not yet been reflected or had not been reflected in our view in the market. There have been rumours of takeover interest in the last month or two. It's impossible to know whether that will come to anything or not. That's not the reason why we bought the shares. We bought the shares because we saw significant value from a business that is transforming itself and actually well positioned long term. and an industry where its peers and competitors trade on really quite high valuations, and certainly much higher than where Tate & Lyle has been trading.
Mouthfeel is one I've not come across before. Just before I let you go, something which could leave a bad taste in some people's mouths, depending on where you sit politically, is the US election. We're talking just as US voters are going to the polls. It's too close to call. That's what I keep hearing. Have you got plans in place depending on who wins the race?
Well, the first thing to say is markets are dynamic, so they already price in a lot of potential change. If there's the risk of or the possibility of Donald Trump winning the presidential election seems to become more likely in the last few months, and the market has moved a little bit. I think the second thing to say is we actually have relatively few companies, very few actually, I'd say, that export a lot of products into the US or import a lot of companies into the US. We have many multinational companies that operate in many countries, including the US. In fact, we got a lot of exposure to the US. But the companies that would be most affected potentially by a Donald Trump victory might be companies that are importing to the US that might be affected by tariffs. We've got very little exposure to that. So I don't think on that area there's a massive risk. I think more importantly is where do government bond yields go, and how inflation expectations. And that will be something we'll need to keep an eye on. But as I say, it's a dynamic situation, and markets can often do things that are very different to what you expect them to do when the results actually come through. So we are fundamentally bottom-up stock pickers. We spend our life trying to find good companies that we can buy at attractive valuations with decent prospects. Most of those companies are not really affected by who's in the White House. They will work around it, and they'll still be strong businesses in the future. So we're not too concerned day to day in our stock picking. I think what you might see on day 1, day 2, day 3 is a move in the market. They move in certain shares versus others. But we'll get back to the day job of finding individual companies to buy that we think can make money and generate a high dividend yield. And so we're not too concerned about the election from that point of view.
Simon, it's been great to talk to you. Thank you so much for your time.
Thank you very much.
That was Simon Gergel there from the Merchants Trust. Right, Danny, normally we'd have tons of earning updates kind of front and centre, but there's a lot of other news to talk about, isn't there, this week?
Yes, there's been so much to talk about between the budget and the US election that I'm literally going to rattle through just a couple of companies which have caught my eye over the last couple of days. And I'm going to start with UK company BT Group, just looking at the FTSE 100 at the moment. The BT Group reported this morning, obviously huge telecommunication company based in the UK. Shares currently down 6%. Now, that was because investors really didn't like the news that BT had to give them a 10% drop in pre-tax profits. Also, revenues down as well. But the bit that really sort of caught my eye that I wanted to talk about here, because we've spoken a lot about potential job cuts and cost cutting by companies, and BT has already been in the middle of that. And it made clear that it's been really accelerating those job cuts. So it has shed 2,000 positions just in the first 6 months of the year. It's looking to get down to between 75 and 90,000 employees, currently at 118,000. But just losing that 4% of the workforce, that 2,000 people, has helped them cut costs by £433 million annually, which is a huge amount. Now, obviously, the new boss, Alison Kirby, came in earlier this year, said that she was looking to accelerate the modernisation of the operation, which would put them in a strong position, really reiterating that today, and has done a lot. I mean, when you look at the full fibre rollout, now reaches 16 million premises, 5G network covers 80% of the UK population, but it is an incredibly competitive market. And of course, it requires BT to put quite a chunk of money in. I also wanted to touch on Persimmon, which gave an update which didn't go down well at all. And that was primarily because of one thing: building costs. We were talking earlier about inflation, and what Persimmon said is that it had seen the cost of building homes creeping up. Now, that, of course, is going to impact affordability. And literally this morning, we're recording on Thursday, we've just had an update from the Halifax, which has said that the price of an average UK home in October hit a record high, almost £294,000, which surpasses the previous peak from June 2022. Which, was at a point where there was this real post-pandemic rush for additional space, or people wanting to move because they wanted a garden or an office and they could work more remotely. But fascinating, we had Asda announcing not only were they cutting jobs, but they were also rolling back on the option for hybrid working, which, if the labour market really does start to tighten, I think we're likely to see an awful lot more of that. And one final one I wanted to talk about was over in the United States, and that's because just before the US election, literally a couple of days before, we had an update from Yum Brands, which of course is the KFC owner. And it had seen same-store sales at KFC falling 5% over the quarter, the third straight decline. And that is in spite of Yum Brands really leaning heavily on budget-friendly options. And it's something that we've seen across the board at a lot of these value restaurant chains, McDonald's, Burger King. They're all trying to do these price wars, offering the lowest cost meal to the market in order to bring in particularly lower income earners in the United States. And that just gave you sort of an idea of how tough people in the States have been finding it. We talk about the cost of living crisis that we've experienced over here in the UK, and you just assume because the United States has continued to have that incredible economic growth, and because we've seen equities markets just absolutely soaring, and there's been a lot of commentary that people that have some kind of investment that are invested in equities, they've really done well, whereas sort of an average American who doesn't invest in the stock market, just is literally trying to get by, has really felt the impact of inflation on their lifestyle. So, yeah, I think that was really interesting. Although, of course, Taco Bell is also one of Yum Brands' chains, and it is still continuing just to find a way to keep people coming through the door. And they constantly introduce new products. They're incredible with their marketing, social media, that Taco Tuesday thing. And I have to say, when it comes to fast food, I do love a taco.
Me too. But I think one's opened up not too far away from me, actually. But I've never actually been to a Taco Bell. I do like cooking them though, and I think they're fun. It's fun to kind of share stuff. So, more food chats. This time to talk about biscuits. Now, I wonder how many people will listen to this chat and kind of wish they had a packet next to them. I definitely am regretting not knowing that it's coming up. So, yeah, it might be a humble biscuit company, but Lotus Bakeries has also been an amazing stock market performer in recent years. So our very own Shares magazine editor Tom Sieber and deputy editor Ian Conway got stuck into a discussion on the business behind Biscoff.
So today we're talking about a company called Lotus Bakeries. Now, Ian, if I say Lotus Bakeries to most people, it might not mean a lot to them. But if I use the magic word Biscoff...
Well, Tom, I'm glad we're doing this after lunch and I've had something to eat because, of course, I went straight to the Lotus Bakeries website and it made me very hungry. So, yeah, they do those little premium biscuits that you get with your coffee in France or Belgium or Holland, little Biscoffs, but they also they have quite a large product range, don't they?
They certainly do. So you've got it spot on. Biscoff is the signature product of a Belgian company called Lotus Bakeries, which I mentioned at the start. And it's a caramelized biscuit. It's been produced by this business since it was formed in 1932. So Lotus was founded by someone called Jan Boone, and he partnered up with the Stevens family in the mid-70s, and they still own around 50% of the company. And Biscoff is short, literally, for biscuit with coffee. And, historically, it's been a snack that Dutch and Belgian coffee drinkers have had served alongside their hot drink. It listed on the Brussels Stock Exchange in 1988, but it's transformed itself quite significantly in recent years. So it's engaged in a series of acquisitions that have broadened the group's product portfolio beyond Biscoff. So in 2015, the company diversified into the healthy snacking segment. It snapped up a business called Urban Fresh Foods in the UK that sells fruit snacks and cereals under the Bear and Urban Fruit brands. And it's also snapped up some other brands in the UK, Kiddylicious, which might be familiar to parents in the UK, Naked and Trek. And these brands, these kind of healthy eating brands, are increasingly being rolled out across Europe. But the UK is very much the company's largest market, despite it being headquartered in Belgium. It accounts for around about a quarter of its revenue. And although it has diversified in recent years, Biscoff is still the star, is still the kind of flagship product. It accounts for around 50% of revenue, with the rest evenly split between Lotus Natural Foods, which encompasses some of the brands we discussed before, and Lotus Local Heroes, which sells things like biscuits, waffles, gingerbread and cakes in markets which include Belgium, but also Germany, France, the Netherlands and Sweden. Now, the reason we're talking about this stock today really is that the recent trajectory of the shares is pretty astonishing. So on a 5-year view, it is up 375.4%, and that compares with a concurrent advance for the MSCI World Index of just 61%. What's that done to the valuation of the company, Ian?
Well, Tom, yeah, it's not cheap for a biscuit company with earnings of, well, for a start, the share price, just to put everything in context, is just shy of 12,000 euros. So that's, to you and me, £10,000 a pop. As you say, the family owns the shares. The family owns 50% of the shares and more of the voting rights. So, they're not really worried about the share price being too low for everyday people to buy into it. It does seem to be on a one-way path at the moment. But for your just under 12,000 euros, you're only getting 190 euros or thereabouts of earnings for this year, and just over 210 for next year. So, again, I'll come back. It's a biscuit company on 68 times earnings this year and 63 times next year, rather. Can't read my own writing, and 56 times next year. So, for, a company that does sort of chocolate spread biscuits and gingerbread, I gather, though, looking at the latest set of results, they are trying to grow into that valuation, if you like.
Yeah. So, I mean, like you said, based on the forecast earnings for this year, the valuation is very elevated. According to figures from the investment bank Berenberg, Lotus has delivered an historical organic sales growth rate of around 12% a year since 2015, and that's been supported by 15% growth on the same metric in Biscoff over the same period. And yes, it is sort of expected to continue growing. The latest results saw better than expected sales growth of nearly 20% in the first half of 2024. These sales do convert into a decent amount of cash as well. So that's allowed for some growth in the dividend, and it means the company has a pretty strong balance sheet. One challenge for the business, and I guess you could sort of describe this as growing pains for for Lotus is that its sales are running so rapidly, it's having to expand capacity, and it's hard for it to do that at a sufficient rate to keep pace. So company's working on it. It announced at the half-year stage that it was increasing its capital expenditure from 200 million euros over this year and next year to 275 million euros. So they're opening a new line in Belgium, they're expanding in South Africa, and increasing the scope of a new plant in Thailand to allow for more Biscoff capacity there. But these investments inevitably won't make a difference overnight. The full impact's likely to be felt in 2026. So, this isn't something that's going to be able to address those capacity issues instantly. There is scope for them to expand further. But again, obviously, it takes time and investment to do that.
So the other thing I read in the results, and I thought this was quite interesting. I don't, contrary to appearances, I don't spend a lot of time in the bakery aisle, but I did notice that they've been really pushing their spread to not just to retail customers, but also to bakeries and so on. So you can get this Biscoff flavor in your own foods, and that's something that American firm Mondelez has done very successfully with Oreo, isn't it? So actually, the company is talking about forming some sort of partnership with Mondelez.
Yeah, well, in fact, it has already done so. So in June, the company announced a partnership with Mondelez. So this is the company behind brands like Oreo that you mentioned and Cadbury's. And this arrangement did two things. So one was that they're going to start introducing Biscoff into their range of chocolate products in Europe. So they're going to basically team up to do that. And also there's an agreement to help launch, or not launch, but further the kind of penetration of Biscoff in India, where Lotus really hasn't made a huge amount of progress yet. So deal will see Lotus retain confidentiality over branding and product recipes, but it's going to license production of Biscoff to Mondelez, which will also be able to kind of leverage its in-country strengths in areas like marketing and distribution. It's interesting you kind of made the Oreo comparison, because Lotus has already been following a little bit the template that Mondelez set with Oreo. So you've got this base product, you've got this cookie, this biscuit, but what Oreo's been able to do very successfully is leverage that into new product categories. So, putting it in ice cream, putting it in spreads, putting it in chocolate, as I touched on there, is part of the agreement with Mondelez. So from this one sort of traditional cookie, it's been able to expand into lots of different products, and Biscoff's already done quite a lot of that, but clearly they see potential to do more. I've been known to take to a Biscoff, a jar of Biscoff spread with a teaspoon. I won't deny it.
So now I see why you wanted to talk about it.
Yeah, this is why we're talking about it after all. But I mean, Biscoff recently hit something like 500 million euros in sales. Oreo sales are some way in excess of this.
Yeah, interesting.
Yeah, it kind of begs the question of what they do next. So
I mean, they said they want to double sales.
Exactly. And in doing so, go from being the 5th largest cookie brand to the 3rd largest, behind Oreo and Chips Ahoy, which coincidentally or not, are both owned by Mondelez. And as part of that, as well as sort of the capacity investments that we discussed earlier on, they've also looked to increase their spending on marketing. So they're gonna do a bit more to try and reach consumers, both kind of online, but in other areas. And I think where the company probably sees quite a lot of potential is in, and they talk about this, on their website, is increasing their sales outside of the core markets, which so around 2/3 of its sales come from 5 markets at present, and yet it has a bit of a footprint in 70, and it's done well in the past in kind of increasing its penetration in different markets. So it will be looking to do the same in these other markets. And obviously, the arrangement with Mondelez in India is part of that.
Tom Sieber and Ian Conway from Shares magazine. And don't forget, the Shares team provide daily updates on markets news, as well as the weekly magazine packed full of brilliant insight. Right. We've had so much to talk about. Let's end up, Charlene, talking about university fees, because I said at the beginning of the pod that this has been dinner table chat. And my daughter, who's set to go to university next year, was not happy at the news that university fees would go up.
No, I'm not surprised, Danny. And, the news is that university fees are going up. So they're going up by £285 to £9,535 from the next academic year. Now, that's the first rise in 8 years, but I'm not surprised that it's unwelcome news for students thinking about going to university. Now, it's welcome news. Perhaps the universities themselves, it's being described as a bit of a sticking plaster because they were calling for much higher rises again to keep pace with inflation. It feels like the theme again this week and for recent years, but it could put students off if they feel they're not going to get value for money.
Maintenance loans, I know that we've spoken on our fellow podcast Money Matters to Save the Student about student costs and maintenance loan. There was a huge push to try and get those bumped up because they've also been frozen for a while. Have they moved up?
Yes, you're right, Danny. Maintenance loans are going to go up, which will be a really welcome move given the cost of living crisis because they have been frozen for so long. So the boost available could be up to £414 for someone living away from home and studying in London. It's a little bit less if you're living away from home outside of London and a little bit less again if you are actually living at home. Now, the maintenance loan itself has two parts. So a basic minimum that everybody can apply for and get, and then as a means tested top up that ratchets up depending on your household income. So if your household income, and that includes kind of step parents and other people in your household, even if they aren't also biological parents, for instance, and if your household income is less than, I think it's £25,000, then you get this full amount. So it's not clear at the moment, and from what I've looked at, how that boost will be applied to people who can't get the whole amount or somewhere in the middle there. Will it be prorated? Or will they still get the kind of full boost themselves? But obviously, this all still has to be repaid somehow. Or for some people, in the case of fees, families might choose to try and pay some of that upfront. And it depends obviously on your situation whether you think that might be a good idea, even if you are able to. What I will say is that, of course, it's kind of unwelcome news that fees are going up, and I know it might cause uncertainty, like I said, for some people who were thinking about whether university the fees might be good value for them, but it's not kind of that seismic change that we saw for the new student finance scheme that's now in place, this kind of Plan 5, that extended that repayment period for from 30 to 40 years. That's the payment period after which the loan outstanding is written off. And it also lowered that threshold for when someone starts paying back the loans to £25,000. So currently, above this amount, 9% of earnings is taken for repayments, described, as that added graduate tax. It's probably fair to describe it in that way. And I had a look at some numbers on this new announcement and kind of find that nobody's actually going to be paying any more each month despite the rise. So, there's not going to be any more coming out of pay packets each month. People who start on a lower income straight out of uni will actually end up paying the same amount back over that 40 years, and more just gets written off at the end. So, the government potentially loses out here because if people don't go into those higher paid jobs, they're going to find themselves with more of that student loan, but written off after the end of 40 years. Obviously, the people in between, they are going to end up paying back more overall because they'll be paying for a little bit longer. The numbers I looked at were people starting kind of on £30,000, £40,000, £50,000 when they leave uni, getting some regular pay rises each year and then sort of chunky ones every 5 years. I worked out it's between 1 and 2 extra years of repayment overall. So yes, the headline isn't great. If you're thinking about going to university, you're already worried about costs. There is more support available. probably is going to take you slightly longer to pay it back. But
yeah, I mean, the one thing for us at the moment, because you don't think about it, I went off to university and I didn't have fees to pay. And because of that, my dad was able to help pay for accommodation and stuff. But my accommodation was something insane, like £20 a week. I mean, it was incredibly low. Whereas we're now looking at having to find a significant sum of money every month in order to pay the accommodation costs, which the maintenance loan, the basic lowest amount of maintenance loan that my daughter can get, it just won't cover it. And I think it's something that until you get to that point, you don't think about.
No, and I think, I was one of the first to pay fees, but they were nowhere near this £9,000 a year amount. And when I first started paying fees, you had to pay them. You couldn't get kind of the loans to help them up front, but going forward from sort of year 2 onwards, you could add it to your outstanding finance. But then you think about that accommodation. I mean, I should know what it looks like now. My half sister's at university at the moment, but I went for the best value. Let's say cheapest accommodation. And, I was in a flat with, there was 5 of us, 3 boys, all sharing one loo and an excuse for a shower in the first year. I mean, we had a great time. But yeah, like looking at these costs now and the cost of going to uni, it would be a much different decision in our house as well. So yeah, it is like you say, it's those things you kind of take for granted until it's sort of happening to you and your family.
If you are now at that point where you've got young kids and you have got a bit of extra cash to put aside, I really wish that I'd paid into a junior ISA and been able to give them a pot of cash to put towards fees, but can't roll back the clock, unfortunately.
You can't. Well, and in times when I was feeling a bit more flush, I did put some aside for my very young children. And now I'm sat there, I don't know what this says about me, but I'm sat there looking at it going, oh yeah, I can't get that until you're 18. It's great for them when they get to 18, but people that they're 7 and 5. Yeah, it works both ways, that bit of hindsight, doesn't it? It's an interesting one. Right, okay, that is it for this episode this week, and we will hear next week from the team at JP Morgan about how that election result is being factored into their decision making. And I'm sure Leighton and Laura, who'll be looking after you, will properly talk through what the Bank of England has to say later today when they make their rate cuts announcement.
Until then, we forgot to mention a massive milestone for the pod because we've just published our 300th episode. So thanks to all of you for listening. And whether you've been listening since the very first episode or are a relative newcomer, don't forget to subscribe, like, and leave a review wherever you get your podcasts. And you can get in touch with us as well. You can email us podcast@ajbell.co.uk. Thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.